Welcome to Smith Weekly Discussions, an occasional program for our readers and listeners of Smith Weekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at Smith Weekly, including Dale H., Michael P., Nick W., and Paul M. John Polomny is our guest today. John is founder and editor of Actionable Intelligence Alert, an investment research and education service focused on various areas of the markets that takes a contrarian, non-mainstream approach to investing. You can learn more about their work at actionableintelligencealert.com. John, welcome to the show.
Well, thanks for having me.
Well, John, for the audience who might not know you and your work, can you give us your background?
So my background is basically that I've worked in the power industry for about 35 years. And that's my trade, building and operating various power plants, whether they're nuclear, coal, natural gas, and now renewables. During that tenure, during doing that, I became interested in investing like a lot of people do, trying to make money in the markets. And I had a particular draw towards the energy markets because I was involved in the energy markets. And I, as most people do, you do reading and thinking about how to go about this. And I wasn't very successful when I first started. And I started trying to figure out why I wasn't successful. And then I started realizing that when I had a particular focus on the energy markets and then the resource markets in general, I began to realize that these are very cyclical markets, and trying to understand the cyclicality of previous markets and then trying to apply it going forward and how to operate in that cyclical environment kind of led me to creating the newsletter and YouTube videos, trying to talk with other folks about this because I lost tremendous amount of money when I first started out. It was a learning curve just because I didn't know what I was doing. And I think a lot of people are in the same boat. I'm trying to give them the information that I learned the hard way so that they can profit and better understand how to operate in this cyclical environments.
And you've done a number of different stuff in the energy industry. I understand you were with Duke Energy at one point, and you've moved over to other parts and pieces of the energy industry. And I know that you're not a big fan of renewables, but at the end of the day, when services are required and you get paid for those services, it stands out to make sense. So can you share a little bit more with us on what you're up to now?
Yeah, like I said, I mean, the current zeitgeist in the West appears to be a desire to build out and use renewable energy, i.e. wind and solar. As I said, I'm not a policymaker. I have my views like everyone else. But you know, in the end of the day, I'm a pragmatic person that has to provide for people. And, you know, the particular trend now is we're not building coal plants in the West. We're not building a lot of nuclear plants in the West. The trend seems to be renewable energy. And if you're in project management and construction, then you need to pivot to that. It's a business decision. And I think, you know, expanding upon it, I think that kind of applies to investing. Something I've been thinking about recently is, you know, I've talked to a lot of folks. Give you an example, you know, people sometimes have these various biases that they have in their mind for whatever reason. Charlie Munger talks about that. And people need to purge themselves of these biases. I mean, in the end, you're investing, at least I am, or speculating in the markets. I think most people are, to increase their wealth, to achieve goals, whether it's education for a child or retirement. You know, we're not here to make political statements. And I think people don't bifurcate those things sometimes, and they leave a lot of money on the table because they are, you know, trying to make a political statement in their investing. And I think in many cases that should be bifurcated. Now, obviously, you know, I take certain stands against certain things just because, I mean, I don't invest in tobacco stocks just because I don't care to be involved in it. I just for my own internal reasons. But I think, just to say, for example, during the previous administration, I mean, we had one of the biggest stock market runs after 2008 because of central bank largesse. But a lot of people were out of the market because they didn't personally like Barack Obama for whatever reason, or they were a Republican and he was a Democrat. That's kind of biases I'm talking about. And I think the same thing, in this particular industry. I have my own views on energy and energy transitions and these things. I've studied this, been part of them. And, obviously in the end, you have to put food on the table and take care of people. And, if renewable energy is what the policymakers and the voters in the Western democracies have decided to do, then one needs to pivot to that if one wants to continue working in that industry. But I'm happy to talk about, energy density and all those things and why, we've never seen civilizations go to less dense energy sources by more dense energy sources in the transitions. But that could be a 2-hour lecture. But anyways, I think some of those biases sometimes, and I appreciate that question because I think that kind of leaks into sometimes in people's, obviously there's certain things, maybe we shouldn't be investing in Myanmar when they're displacing their Muslim population, stuff like that on grounds. But I think just to take this adamant, I'm not going to invest in, like, say, nuclear power because I'm against it. And a lot of times you can't give good facts as to why you're against it. It's probably not prudent in some cases, as an example.
Yeah, absolutely. No, I agree with you. And back in the Northwest, for some consulting that I do, for example, there was many contracts to take out old hydroelectric facilities, decommission them, tear out old forest roads, decommission forest roads. The difference was, even though maybe the policy wasn't necessarily sound, the contract had attached some money and some work to it. And so it made sense to go ahead and move forward with some of those projects just for the purposes of it was work and it put food on the table, even though you may not agree with the policy of removing forest roads or removing hydroelectric facilities. But yeah, certainly interesting comments, and your comment about Obama, for example, in light of the cast of characters and clowns that you have running for office now, he doesn't look so bad. If you look at some of the policies that are being proposed by some of these other people running for the office. So it's put it in perspective, and certainly interesting parts and pieces there. And McDonald's, for example, I don't necessarily agree with eating at McDonald's every day. It is a fine stock, and I do occasionally stop at McDonald's from time to time, and certainly try Hershey's bars and Hershey candies out and do that as well. And it's certainly unacceptable that I could eat it all day, every day, but nonetheless, I certainly like the companies and I do like the products. And I think to some degree it's take it with moderation. And I think the same applies with nuclear power. Whether you're for or against it is irrelevant, but when you look at the sector, you have to put a unbiased view on to what is going on in the sector and what could potentially make sense from a financial investment standpoint. And I think you touched on those subjects. I think it's fantastic. Well, John, can you tell us in general how you approach your investment ideas and what things tend to spark your interest when you are looking over the markets?
I'm lucky in that, I guess it must be just genetics, but I'm an innately curious person. So ever since I was a little kid, I'm a voracious reader and consumer of all types of information, and sparking curiosity, or if I see something that in my reading or something that piques my interest, then I will veer off into these various wormholes, and who knows where I end up. And I think I go back to, again, Charlie Munger is one of my heroes. I remember he said something to a graduating class of Stanford MBAs one time. One of the graduating MBAs stood up and asked him, what's the key to your success? And he said, read 500 pages a day. And, he said the same thing, that's all him and Warren Buffett do all day. He said, Warren and I sit around and read all day. So I think, what I do is I take in all types of information. I read all different types of things, not just financial books, but if I'm interested in something electrical or magnetism or who knows what, anything, it could be anything, a chemical reaction or something, I'll go off in some wormhole study. And I think when you do that, it creates a lattice work of information in your brain, or it does, at least in mine. And then sometimes when we're talking about energy, for example. I mean, I understand, and I've read the history of energy and energy transitions during the Industrial Revolution in England, things like this. And I understand what it takes, because I'm in the industry, to create and maintain this advanced technological and industrial societies that we live in. So I start there with my information. Something will pique my curiosity. I'm an extensive traveler. I travel all over the world in very weird places. In the last 10 years or so, I've spent a lot of time in Central Asia, former parts of the Soviet Union, and people ask me, like, a lot of my ideas come from there. I mean, in my investing, really interested in emerging and frontier markets, and people ask me why, and I'll tell them, well, it's like Willie Sutton said, why did he rob banks? That's where the money is. And why am I interested in emerging and frontier markets? Because that's where the growth is. That's where the positive demographics are in the age group. So I think, it kind of starts there, then I'll go down whatever rabbit hole, and then wherever it takes me. Like with this energy, I mean, I hedge my bets. I feel that hydrocarbons are not going to go away for many decades. They're going to be with us. I do think that other forms of energy, are, whether they're going to be politically forced or market forced, are going to be included, i.e. renewables, so that I hedge my bets. So you start talking about various levels, for example, of electrical vehicle penetration. Well, what does that mean for copper demand? What does that mean for nickel demand? What does that mean for cobalt demand? And you start putting together a spreadsheet. You start diving deeper into information, talking to other people in that industry. Then you start realizing, well, maybe people haven't thought this out, because in order to get to where these linear projections are taking them, these materials don't exist. So then that starts sparking well, if they're going to force this, or it's going to end up at their 30 million electric vehicles per year, or whatever they're projecting down the line, then there's going to be there's a big gap in the materials to get us there. And I think a lot of people forget that. And I think that creates then an opportunity in my mind, which then leads me down to talking about or investigating various methods or vehicles to take advantage of that particular opportunity.
Fantastic. And I'll have to twist your arm one of these days, get you down into Central and South America looking around as well. And it sounds like you've been to some potentially nastier places than even that. So all good stuff there, John, and certainly understand why some nights we're up at 1, 2 in the morning reading, investigating stuff. And of course the wives are saying, why aren't you in bed?
That's it.
Well, I want to ask you thoughts on the broad market today, and what areas do you see as places that are worth paying attention in these bull market? What do you see going forward?
Well, one of the things that I've kind of come to the conclusion of is that, if you're going to talk about the overall markets, I mean, I've kind of realized I really have no advantage there. I mean, if you're competing against, Bridgewater Associates or, Goldman Sachs, Morgan Stanley, they have banks and banks of AI and PhDs. And so I don't have a general view on the markets. Obviously, if you ask me what I think, I will say that they are historically overvalued based on history. However, I also have come to the view, which I realized a long time ago but kind of forgot, is that monetary policy has a big influence on these equity valuations. I mean, money creation or lowering of interest rates. I mean, the financial press is really not doing anybody a service by not questioning the intelligence of cutting interest rates when we supposedly have the best economy with the lowest unemployment and 2 generations and all-time highs in the stock market. I think anybody that's invested in the general stock market in the United States, at least, is sitting on a pile of dynamite with a fuse that's lit, and you don't really know how long the fuse is. So I think that over the next 5 to 10 years, based on I'm a big fan of CAPE ratios and that mean reversion. Meb Faber, who people can look up at Cambria Associates, he's written several books about this, mean reversion, using the CAPE ratio to look at historical valuations of undervaluation, overvaluation. And basically where we sit right now in the U.S. is that we are looking at 10-year returns into the future that are going to be in the low single digits, and you can possibly expect a very large drawdown in one of those years of anywhere from 30 to 60%. So that doesn't mean that the market can't go higher. I think it will. I think that typically have blow-off tops historically in sediment. We haven't really seen that. I think that with monetary policy where it's at right now and loosening, I mean, I track worldwide interest rates. That's another thing that's kind of a contrarian view I have, is that we're actually starting to see some turnaround around the rest of the world, seeing over 80 different central banks cut interest rates or get easy with their money over the last 6 months. And at some point, this wave of liquidity will have a tendency to, you can force nominal GDP growth if you print enough money, let's put it that way. So I'm not a big fan of the U.S. stock market in general. I think it's overvalued. I think there's some sectors there that you can be active as a contrarian over the next 5 to 10 years. I think are going to do very well, that are undervalued and have demonstrated they can be counter-cyclical. But overall, I'm not a big fan of U.S. equities in general.
You know, the markets today, they seem, when you look at natural resources and the non-performance of the whole natural resource spectrum, it just looks very, very similar to a 2000, 2001 type scenario where you have all the money's on one side of the boat. It's in the broad market, it's in tech stocks, it's in weed stocks, cannabis, biotech, cryptocurrencies. I mean, it is all over there, and no love, no attention, no capital is in the natural resource sector. And it just looks, for us, fantastic. So it'll be very interesting to see how this goes going forward. And obviously there are signs of life in the natural resource sector now. The uptrend appears to be in place, and we certainly are moving off the late 2015, early 2016 area. And everything is generally higher, even including the uranium sector. In general, most of your stocks are off their lows. The uranium price is off its low. And a lot of other sectors, I think you have that as well. If you go back and look at copper, for example. So I think we've got some interesting things coming down the pipe, and certainly excited to be here and be ready for what's next. Well, let's talk uranium for a moment, John, if that's okay. I want to talk about other sectors in a little bit here. Why is exposure to uranium important, and where does it stack up on risk versus reward and outcome certainty for you?
As I stated earlier in the conversation, I'm a generalist investor / speculator. So in general, when you look at nuclear power, having been in the nuclear industry when I was in the U.S. Navy, I remember one of the admirals saying that at some point it would be so cheap that it'd be giving it away. Now, obviously, that's not the case. But what I see is, from the perspective of being the cleanest, cheapest, best source of power, nuclear power fits the bill. And I think people need to look at it from an energy density perspective. I mean, you can do the research, but I can't remember off the top of my head, but it's like 1 pound of uranium equals so many carloads of coal and so many, thousands of barrels of oil, things like that. And I think that, energy underpins everything that we do, every facet of our life, every activity. And energy demand is going to continue to grow. And if you look at just developed economies, whether in Western Europe, the United States, Japan, South Korea, and then you take the populations of emerging Asia, i.e. China is not even fully developed yet, India, Indonesia. I mean, you're talking about 3 billion people. You're talking about 1 billion people in this world that have never flipped the light switch. And then you look at the situation, for example, we use in China. I mean, in China this year, in recent news reports, they're going to build the equivalent of the entire, 168 gigawatts of coal-fired, that's 168,000 megawatts of coal-fired generation this year just in China. That's almost the entire amount that's currently operating in Western Europe. So the demand for electricity and energy is there. And if you can Google this, I use this exercise all the time, Google images of pollution or air pollution in China or Beijing. Everybody's walking around with masks and in the fog. It's not necessarily CO2 that you're seeing there, because CO2 is odorless and colorless, but you're seeing particulate matter. You're seeing this is very dangerous, breathing in the constituents of coal-fired emissions and automobile emissions. And I think that, if you're in a situation as a policymaker in China or India, the demand is there. You have to increase energy production for your economy to move forward. you can't kill the population while you're doing that. So, and if you're in a situation like a lot of economies there, you want a diversified energy spectrum. You don't want to just be dependent on one form of generation. That just is prudent from a policy making standpoint. So I think a lot of people get lost in, because they have home country bias or things of this nature, that, well, there's not a lot of nuclear development in the United States. There's just, Vogtle reactor being built out east. And then in Western Europe, obviously, you have, with the exception of France and maybe I think Sweden or Finland's building another reactor, Germany's talking about closing their reactors. I mean, the focus really needs to be on Asia and the fact that nuclear power is a growth industry. Now, it's not growing at 10 or 12% a year, but it is growing. There's more reactors operating now than before Fukushima accident, and there's more reactors under development and being planned. So the problem is that there's no fuel substitution in a nuclear reactor. It requires uranium and no other fuel. I'm not going to get sidetracked into thorium and that science fiction. Obviously, maybe down the line that will become a reality. But currently, right now, to fuel a nuclear reactor, you need uranium. And there certainly has not been enough development of new uranium sources. It's not that we're going to run out of uranium. It's just that the price signals being sent to developers and producers is not sufficiently high enough to meet the demand that will be required. So I think that creates an opportunity for people that can see that and understand that. And, you can look at various numbers. I'm not the best one to speak to. Obviously, we can mention names here, people that are, knee deep in this and that's their life 24/7, Mike Alkin or somebody like that can give you all the exact numbers and down to each reactor and each mine. But, the bottom line is this industry is basically in liquidation. You are living off of the investment that was made 10, 15 years ago. Every day you can go on the World Nuclear Association, WNA website, and have a tab there called New Nuclear. And just about once a week I go there and you'll see a new reactor either being put on the grid or they're laying the foundation for the first reactor. It's constant building and commissioning of reactors, but you never see anything about any new mines being developed or being built. And I think that as a speculator or as an investor, you can see that when you have demand growing and supply shrinking, that at some point they're going to intersect and you're going to have a price response. I think Marcelo Lopez at L2 Capital has like the 4 things you really need to pay attention to. Ask yourself, is demand going up? Yes. Is supply going down? Yes. Is there any substitute for these reactors besides uranium? No. And do these fuel users, the power companies that require the uranium, do they eventually have to come back to this market and start buying uranium fuel in long-term contracts? So this is how it's traded. Now, there's a lot of focus, obviously, on the short term, looking at the spot price. That's really not the thing to look at. These utilities like Duke Energy or Southern or any big utility makes these decisions in long-term, multi-year segments. They don't just go out and just buy. I mean, it may occasionally opportunistically, but most of the deals are done long-term. So I think what's going to happen is we're going to wake up one day, there's going to be an announcement that a Duke Energy or something like that just signed a contract with Cameco or who knows who, at $42 a pound for this much uranium for the next 3 years or something. And I think that will be the ultimate catalyst that gets this thing going, because, fuel buyers are just like everybody else. Investors they're herd animals. So there's been this perception, I think, that there's this overabundance of supply out there that maybe isn't correct. And people get into these rutted road type of thinking and they can't get out of it. But then I think that, you can look at the charts about uncovered demand and things of this. At some point, they're going to have to come back to the market in a big way in the next couple of years. So I think that's the opportunity.
Yes, you covered it quite well. You covered everything there. And as we continue to spend time on the sector, watch the events that are occurring, we become more and more certain of the outcome. And it's just a matter of watching the clock tick, making sure you can maintain your strategy, your solvency as you go through this process of patience. And so we become more and more certain as time goes on. And also, as we remain in a lockdown type situation with this market, you can even start to cut out new growth, if you will, where the existing fleet will cause a problem in itself. So if you just take away shutdowns and you take away new connections and you just stick with the existing fleet, run that out, you're going to find that there is a problem even with the existing fleet with consumption and obviously the supply available and the bottleneck, of course, that we know that exists with the whole fuel cycle, and of course the construction of new mines, etc. So the more time this goes on, the better it looks. And it seems to be the worse. The equities continue to flounder, which is fantastic because it allows you more time to buy more of good equities. And so I think it's just a fascinating, fantastic situation, better than anything else out there. I mean, you and I have both looked at a lot of places in this market. This is without a doubt the best place to be, bar none. I mean, it's just fantastic. So I'm really excited to see how things play out and happy to be along for the ride. Well, and you also mentioned too, John, I mean, when you talk about India, China, and Indonesia hasn't really jumped into it yet. But when you talk about just those three nations, we're talking, I'm pretty certain it's going to be at current numbers, pretty close to, I'm going to say roughly 40 to 45% of the world's population. That's China, India, and Indonesia. Just those three nations. I mean, it is a chunk. If you go look up the information that's available there, I'm pretty certain that we're awful close to 40%. That is substantial demand for energy going forward as these nations continue to build out and modernize their electricity grids and so forth, and how they get their energy. So I think it's really an amazing situation that we've got going. What do you think at this point, given your time in the market for uranium? What do you see right now that investors are really missing with regards to the situation that we have right now in uranium? Is it patience that they're missing? What do you see that's being missed?
I think that's the big thing. I mean, I like to quote kind of jokingly on the YouTube channel, talk about Uncle Jesse. You know, Jesse Livermore was a famous trader back in the 20s and 30s. Now, I will caveat this by saying he ended up blowing his brains out. But anyways, he did have some good. He said that good advice. He said, you know, the most money he made wasn't in his buying and selling; it was in his sitting and waiting. So, I think I get a lot of correspondence from guys out there that are speculating in these markets, and they can see the opportunity. They can conceptualize it. They understand it from the arguments, the facts. But I think that, you know, the inability sometimes and the patience, that's one of the things that people don't have. They can say, well, I can see this is going to happen. I understand what you're saying. I can see that it's a supply and demand situation. But, you know, when is it going to turn? I mean, and I think that, you know, that's a question that really can't be answered by anyone. We don't know the exact timing of it. What we can say is that historically in these type of markets, resource markets, in particular uranium, I've heard like people say before, you know, of a gold bull market, it's like, you know, can get pretty radical, but I mean, the uranium market is like just the ultimate asymmetry. I mean, you're talking about an industry right now that, if I got my numbers correct, I think at the top of the last bull market, you could have bought the entire industry for $150 billion. And currently, I think the total market cap of the entire industry is, you know, 8 or 9 billion. So if you just want to keep those things in perspective, and to your point, Andrew, what you said earlier was the tighter this band gets, every day that goes by, uranium fuel is being burned up in those reactors. And the thing I emphasize to folks is that we know that there's a supply-demand deficit. We know that some of the things, without getting too depth, you know, SWU pricing is going up. Some of the other intermediary parts of the fuel cycle, those prices are increasing. So it's going to drag along the uranium price at some point because the demand is increasing. And I tell people, you know, people have this view, especially younger guys that came up in the tech, you know, I'm 52. There's a lot of guys that I talk to in their 20s and stuff, and they're savvy technologically. I can't just call up some guys in India and have them write an app to create a new uranium mine, you know, do an all-nighter and do that out. I mean, this is something that's going to take 10 or 15 years from the finding of the resource to permitting, to developing, to building, and both of us being in project management, construction, consulting. I mean, nothing ever goes right. I mean, everybody's trying to wreck the project, and it just, you know, there's one problem after another. So even when you're planning a project, when I'm building a plant, I mean, it still ends up being, taking longer than anticipated and unanticipated problems. And I think, understanding that and then bolting that onto the thesis just just it's like on a drag strip, and that's your nitrous oxide. I mean, the fact remains, I think that and I don't like to use hyperbole or anything, but I really think this is going to be a longer, sustained, and more when the snapback comes, the volatility to the upside and the duration is going to surprise a lot of people, including a lot of the nuclear reactor operating companies, because I just don't think people really are understanding. And then, of course, you could have another, who knows what's going to happen. You could have another Cigar Lake or something like that that could really, constrain the supply even further. That's what really accelerated the last bull market, when they had the flooding in some of in the mines. So, I mean, these things, and I think once the sediment change happens, as you well know, you said the same thing. We've seen some bottoming. We've seen some of these things, and that's what happens. The AI right now, you've got retail in there. There's no professional money in there because they just can't get in there in size. And if they do, they're looking at CAS Atomprom or Cameco or something. So when this thing actually turns and the computers pick up on it, and you see comps quarter to quarter, year over year, as the price increases and some of these companies actually start making some money, you're going to see the capital come in and it will start building that head of steam, if you will. And I think that this thing will obviously overshoot to the upside. That's what happens in these cyclical markets, and uranium being one of the most thinly traded, and that's what people don't really understand. I mean, if you look at it as market cap, it's just if any kind of real money comes into this thing, it'll double and quadruple very easily. Now, I'm not trying to be, like I said, I don't want to use hyperbole, but you saw several stocks in the last bull market go up 1,000, 5,000 to 10,000%. Now, I don't know which ones those are going to be. I'm sure it'll happen again. So people will ask, what is, I have no clue. So, but that will happen. I mean, even Cameco will probably, big companies like that will go up, 5 times maybe. That's what happened in the last bull market. So, I mean, I think to your point, if played correctly, if you have the patience, you have the opportunity to add a 0 or 2 zeros to your net worth if this is played correctly. And I want to emphasize, this is very speculative. To the point, we really don't know. None of these companies really make any money right now, especially the juniors. They have no income. So it's very speculative because we are waiting on this turn. But to your point, I think a lot of the leading indicators we're looking at, or a lot of folks are looking at that know more about this than I do, are suggesting that is happening. And with these herd animals in the utility industry, because I worked there for many years, once the sediment changes, it will, be like the gazelles and a leopard chasing them or something like that. I mean, I don't want to use too many, these now metaphors, whatever. But anyways, it's that's how I see this thing happening, and I'm content. I participated in the last one. I saw what happened. I mean, literally, Andrew, if you remember correctly, during the last one, every week the new pricing would come out from the UxC or whoever, and uranium would be up $1, it'd be up $2. It was like it didn't ever go down. It was like for a year straight, it just went up every week. And as we topped out was $135, $140 a pound or whatever it ended up being. So the stocks responded. Am I suggesting that happens again? I don't know. History doesn't repeat, but I certainly think it's a possibility. And people are talking about, this is where you know that this thing really hasn't got going, because people are talking about, well, if we get up to like $40 a pound, it's going to really do something to these stock prices. Well, what if we get up to even the old price when we were at before Fukushima was $70 a pound? That would do, you would see 10 baggers there easily. So I think that's going to happen, but it's going to happen over a period of years, and I think it'll be sustained and more volatile to the upside than I think a lot of people are anticipating.
It's certainly going to be entertaining when you talk herd animals. Not only that's funny. I like that. The utilities, people give them too much credit. I'm sorry. There are smart people there. I get that. There are smart people in many places, but I can tell you that just in my experience with electric utilities on the contract side, through consulting work in the past and through my experience, these are ordinary people. There are some that excel above others and have higher levels of talent. But at the end of the day, these folks, like you said, are generally herd animals. They don't know what is going on at uranium mines. Some do, but a lot don't. They sit in their office. They do the things that they're supposed to do within the parameters and conditions of their policies. Many of them don't have a clue about some of the things that happen in their business. And so they all have their departments, but I can tell you based on my experience, not specifically in the nuclear power generation side, but certainly in dealing with other utilities that generate power within the U.S., notable utilities, not everybody there is extremely smart. A lot of them are ordinary people, and some of them just flat miss these types of trends that we're speaking of. Also, as you said, with regards to some of the gains, John, during the last cycle, just go back to 2016, late 2016, early 2017. I mean, there wasn't a uranium stock that didn't at least double. There was some I can remember during that period that were a couple 100%. And then I remember some notable standouts. One example I refer back to is Summit Resources for a couple week period. I think at one point it was up 800-900%. I believe the chart's probably still out there, so you can go back and look. But so it doesn't take much to get moving. What I like about this time around, where we're at now, is you have a sustained, strong hand movement. It's much better, more sustained at this point. So I think some of the weak hands are shooken out, and I think we're getting ready to continue the uptrend. So I think that's where we're headed. Now, John, how about strategy? Can you just allude just a little more detail on what you think is kind of the better setup to take advantage of the sector, as far as maybe allocation, if you can speak to that, maybe a number of exposures, the stage of company that you'd like, or a mix, and then how you would maybe go about entry and exit?
So my personal way of looking at this right now is I look at the industry like I look at most of the junior resource market. And, well, you used the word entertaining before. It can be entertaining. You need to, as somebody that wants to participate in this, you need to understand what you're dealing with here. And you're dealing with, for the most part, with the exception of Kazatomprom and Cameco, which Cameco actually reported losses, but most of these companies have no sales. They have no, they're not mining. There's small mining going on with a couple of the companies here in the U.S. or tails processing, things like that, but not a sustained growth of production, obviously, because the price doesn't dictate that. So you're dealing with companies that a lot of times up and down the spectrum, you have companies that have excellent properties that are, I mean, I can think of, I like, a company like NextGen. I mean, that's probably going to get taken out during this next bull run. Not to recommend or anything, but you get companies where you have good resources and good places with good infrastructure, and then you have, moose pasture in Saskatchewan. And I'm not going to get into what I think, people can make their own decisions. So you have different skill sets at these different companies. Some of them definitely have prospects and have good potential. You have jurisdictional things you need to look at, i.e., there's a difference between operating in Canada and operating in Mali or Niger, where you have, the possibility of Islamic violence there with some of these terrorist groups. So you need to look at that. And what I think the most important thing to look at, though, is the management teams and the people actually running the company. And that is emphasized by a lot of people, but I think people gloss over it. I want to, my success in life, and I've done business and other things in real estate or angel investing and things like this. Whoever is running the company, you really need to understand who this person is and what their experience is, if they have done this before. I mean, I hate to use, some of these quips that I use, but, I'm betting a lot of times on the jockey, not necessarily the horse. A crappy management team can wreck a good project, but a mediocre project can be made. A good management team can squeeze every drop of juice out of the project. So I think aligning yourself or taking a look at companies that have done this before in previous cycles have been successful. I think the second thing to look at is, how much cash do these companies have? Because as I said before, they have no cash. How do they get cash? They issue shares. And you need to really be cognizant about how this management team is spending the money that they're getting from these private placements and other ways that they're obtaining cash. Because in the end, you can get to a point where you have diluted shareholders so much that when the turn comes, the participation won't be as lucrative if you've been diluted into, hundreds of millions of shares so that you can support the lifestyle of a particular management team. Obviously, we've talked about this before, but lifestyle companies, I call some of these companies. So I don't want to get into, I don't like trashing different companies. People can do their own research, but there are known quantities out there. If I was just a casual investor, not a speculator that's going to deep dive this, because you need to do the work. I mean, this is why it's not easy. People don't seem to understand this. There's a lot of work involved with going through and doing and determining which company is which. But if I was just somebody that said, well, I get the thesis and I want to participate in this with some portion of my money, risk capital. Recently, I don't know, there's one in the US that just came public last week, but there's a good ETF in Canada called the Horizons. I can't remember the exact uranium producers, whatever ETF. It's HURA in Canada. But if I was this casual investor, it's market cap weighted, so you're going to get a lot of Kazatomprom in there. You're going to get a lot of Uranium Participation Corporation, which holds physical. You're going to get a lot of Cameco, and then you're going to get a lot of the juniors mixed in, but it's going to be market cap based. Is that going to give you the 10,000? No, you're not going to get out 5,000% return. But if you were just somebody that was a casual investor or a general investor and you wanted to get exposure, that would be a good way to get it. Otherwise, I think that you really need to take the time to deep dive these companies individually. And there's 40 or 50 companies out there that are legitimate, or not, maybe not legitimate is the right word, but they're uranium companies, and then you need to go through and classify those as tier 1, tier 2, or tier 3, and then understand the risk. If you're a development company that has a project ready to go, if you are just a developer that has moose pasture or recycling old mines that have went through several owners, people need to understand that. So I think that just depends what type of work you're capable or wanting to do, and then also understanding the people that you're dealing with. And you need to get, I encourage people, call these companies. They will take your call, and you will be able to talk to people. And I think I think everybody that's going to be involved in this kind of a side note, but I've said this before, I think everybody in their resource investing career should go to Vancouver to one of these conferences, and you will fully understand that this is an industry upon itself, in a large part to separate money from people, the naive to the people in the know. It's a very tight circle of people in Toronto and Vancouver that run these companies, that circulate amongst each other. And as George Carlin said, it's a club and you're not in it. So you need to be cognizant of that going into this. And that's just how it is. So everybody you talk to, management team, is going to tell you the best story, and you need to be prepared to push back and ask the hard questions. Have you done this before? Who's on your staff? Who's your lead geologist? Whatever, bank of questions people should have. And then, what are you spending money on? Why are you spending money right now? If you are, and what you hope to achieve, and why are you doing that in this current market environment? Things like that's the kind of questions I ask. So that's what I encourage people to do. If you're just a general investor, maybe the best thing to do is, like I said, look at maybe one of those ETFs. I would stay away from URA. That's a disaster. That's not legitimate for uranium. That they've polluted that with all types of engineering companies and large cap companies that have very little to do with nuclear or uranium mining. But there are some new ETFs that have come out that can get the general investor some exposure with minimal amount of. Then you just have to kind of just keep a high level 30,000 foot view of the uranium industry.
Well, that's good information, John. And yeah, certainly the URA has been a disaster, and it's sad. And we were disappointed with our discussion with URA, and it really is severely misguided. And I hope they are able to install some experience and talent there and get things on the right path at some point there. And also, I like the tiers. You got tier 1, 2, and 3, and then you've got also the tier trash, which is also another one that people can throw a lot of these names into as well. And each of us, and I know you have too, each of us has to some degree made our own private ETF, where we've gone out and selected our own companies to participate in this. John, can you speak just a little bit to yourself as far as what you might be trying to do? Can you just speak broadly to maybe the number of companies you feel is adequate for a portfolio here with uranium? And are you looking at all the stages? Are you looking at explorers, developers, and producers? How are you kind of handling that?
I have exposure. I mean, I have some of the physical I hold through uranium participation just because, I just as an anchor, if you will. I think that everybody should have a little bit of that. You're not going to get the big returns, but it just depends what you're trying to achieve. Myself, I go to a lot of the juniors. I'm looking at China and India and their build outs that are going to happen over the next 20 years. And I'm like, where are they going to get their uranium? And I've been to Africa. I've been to other countries, third world countries, and everywhere I go, I see Chinese people. I see Chinese engineers. I see Chinese companies doing construction. I see Chinese everywhere. And there's an excellent, if people want, just as a side note, to get a perspective, people should watch this movie on YouTube. It's called Empire of Dust, and it shows the documentary, kind of older documentary, give you a flavor of what's going on in Africa. You're seeing the Chinese there. This is made in the Congo, and the Chinese are building a road for the Congolese. This is what they do. They'll go into a country, they'll start building roads and infrastructure, and they do this as a political move to ingratiate themselves. And they are voracious the amount of materials that they're going to need. So I'm looking at, very large projects in Africa. Why? There's stable countries there, Namibia. Even I don't have a problem with Niger or Mali, these places, because I always know the French Foreign Legion and paratroop corps will be brought in by the French if it gets too out of control. But large potential resources is what the Chinese are going to be looking for, and they're not going to come to Canada and buy NextGen. The Canadian government won't let them do that. They're just not going to be allowed to come to some areas, but they will be able to go to places in China or in Africa and some of these other places where these large resource banks are going to be made available to them. And then you're looking at, some companies in Namibia that have some prospects. You've got Paladins out there. They have a Langer Hydra can be brought back online pretty quick. You've got, I'm a big fan of John Borshoff at Deep Yellow. He's done this before. A lot of people don't like it because they think he mismanaged the last thing. That's regardless. The fact is that he created Paladin, and I think he's going to repeat the success. So I think that I'm looking to see where are the Chinese and Indians going to go for their material. They don't have it in their own countries. They're going to have to go to places they're going to be able to play ball to get large amounts of material. They've already done that beginning. I think there was a recent acquisition Chinese made. Mine from Rio Tinto. I can't remember the name of it off the top of my head, but it was in Africa. So I think, there's some analysts out there that call these countries AK-47 countries or whatever, but you just have to kind of differentiate and look at what's reality. I mean, in the end, the Chinese, for example, have actual armed troops in South Sudan guarding some of their infrastructure, oil infrastructure. It will come to that if it has to, because they're not going to shut the lights off in China. So I think there's some prospects there. I'm a big fan of, I don't know, the share count's way up there, but I do like Monroe over at Bannerman. I like what he's doing. I think he's a very savvy executive, not necessarily endorsing the company. I have a lot of shares out there, but, I think he's up and comer. So I think, there's some select things you can do there. But again, these companies are, they're going to be cash constrained at some point. You just really need to keep track of their cash levels and what they're planning on doing. But that's what I'm looking at. It's like the growth coming from Asia. They're going to be building hundreds of reactors over the next generation. Where are they going to get the material? I don't think you can go to Australia is going to let the Chinese in and come and buy out everything. So they can do business in Africa. And I think there's going to be some big acquisitions there. I mean, I think there was an announcement this morning that, Chinese National Gold Company or one of them bought, a big gold company up in Canada. So they're out looking for things. They have the money and they need to do that. So that's kind of what my focus is. I don't want to give too many of the names away because some of them are in the portfolio, but yeah, that's kind of what I'm looking at. I want to look at a big resource and the ability that the government will let these other governments play ball there and let them make the act. So that's where the big money is, I think, with the development of those reactor fleets over the next 20 to 30 years.
Interesting views, and appreciate you sharing some of the names there, John. And certainly Namibia in Africa is hands down the best jurisdiction in Africa when it comes to uranium. without a doubt in my mind, as I continue to study the jurisdictions there. And so I think it makes sense. I think that Africa is certainly part of the portfolio, part of the strategy. With regards to companies, I know you mentioned John Borjoff and Paladin. Every company who was not bought out or taken over during the last cycle has catastrophically failed. And it doesn't matter because they all went down 90% or more. So I laugh at some of these examples where they all hurt. Everybody got hurt. Everybody lost 90%. So whether you call 90% a success or 100% bankruptcy a success or a failure, I don't quite see the difference. I mean, you got cleaned out. That's just the bottom line. If you stuck through, any other company that still exists today got completely trashed. And whether they went to bankruptcy or not is just a footnote. At least that's how I see it. Maybe I've got my stuff incorrect, but that's how I see it. Well, let's move on. Let's move out of uranium for a moment and just talk a few other sectors, John, before we wrap up here. Oil and gas. What are your thoughts? Just give us your brief, big picture thoughts for this sector, and offshore, onshore. Just give us your big picture view on this sector.
Natural gas, I'm staying away from because it's further out. I think it will be something to look at down the road. Oil right now, I think, I look at the facts. Anybody here can go and get off listening to this. Go look up the BP statistical review. BP comes out every year. They've done it for many years. They have this statistical review. They go over every energy source, every country, what the energy breakdown is, what the projections are for these countries growing over time. And the bottom line is that, we use oil because it is dense, it's cheap, it's ubiquitous, and it works. We don't do it because we have guys sitting up in New York City at Exxon wanting to poison the earth. We use it because it allows civilization. That's just the bottom line. And I'm not going to have these arguments with people anymore about it. That's just how it is. If you want to see what your life would be without it, I encourage people to go to understand what energy deprivation is, because I've experienced it in the third world. Go to your breaker box, open the disconnect on Friday, and live through the weekend with no electricity. You'll find out very quickly what life was like without a lot of energy. So I'm a big bull on oil. Same thing basically has happened in oil that's happened in a lot of the commodity complex. Oil underpins every part of civilization, mostly as a transport fuel, but it's used for everything, Andrew. And I think I stand there and watch it. Just as a side note, somebody like Greta stand there with her wetsuit on for traveling the Atlantic in her carbon fiber boat with all this fiberglass and plastics and all this stuff, just completely oblivious to the fact that all that comes from the other half of the barrel of oil that's not used in transport fuels. So I think that it's not going away. Yes, there'll be an energy transition down the line. I don't know when it will be, but in the immediate future, oil needs to be used. And again, there's been insufficient investment around the world because we have had an artificial supply response here in the United States and the shales based on low interest rates and market height. And none of these companies here, very few of them, I should say none, very few have made any money, much less cash flow positive. So that industry now is blowing up like cannabis. It was a bubble. You're seeing production go down, an emphasis on cash flow, living within cash flow by managements, returning cash to shareholders via buybacks. You see many of these stocks down 80 or 90%. That should tell people something. A lot of bankruptcies. And if you follow the, frac spreads down, the whole thing, the thing's rolling over. And what you've not had is you've created this air pocket of 5 to 7 years where insufficient investment was being made around the rest of the world because the price signals were not sufficient to induce companies to do that. Add on top of that, two other things I think people miss. This zeitgeist, you have these oil executives, they get pulled in it too. They're being sued by various states and cities for, CO2. They're trying to go green again. It's the second time BP has went down this track. And what you look at, the reserve life indexes of these companies, they're in decline. Typically, unofficially, they try to keep their reserve life, the amount of reserves they have is 10 years of their production. And most of these companies are getting out of that. As a matter of fact, Shell is down to 7.5 years. It's just been completely inadequate investment. And I think what you're going to see is an excellent opportunity. Just real quickly, in Canada, it's really exacerbated. You have companies trading up there that are cash flow positive, that have 10 to 25% cash flow yield. So you basically have a company, I'll use a company like CNQ, was one of the largest oil sands operators. It has approximately a 15% cash flow yield. So what are they doing? Well, they're just have maintenance capex going on, and they're buying back shares. If no one else will buy the shares, they're going to buy their shares. You have a company, I'll just throw this out, Meg Energy is a perfect example. It's a 25% cash flow yield. What are they doing? They're maintenance capitalization, holding production steady, not growing production in this environment, but they have a 25% cash flow yield. What are they doing? They're massively paying down their debt. And, you have companies left and right there that are just buying back shares by the handful. If no one else will buy their shares, they'll buy. In some of these companies, if you have a 20% cash flow yield, you can buy your entire company in 4 years if nothing changes at current oil prices. And I think oil prices are going higher over the next 3 years. So I'm particularly interested in offshore oil. 30% of our oil comes from there. It's been severely deprived of capital, massive amount of bankruptcies, massive amount of consolidations. When it does snap back, which is inevitable, you're already seeing a recovery in the shallow water and jackup rigs and things like this. Rates are going up, utilization rates are going up. They're tiptoeing back offshore, if you will, into these cycle the projects quicker and they're cheaper. You're seeing the recovery there. And I'll throw one out from, I'll throw out a company I'm excited about is Tidewater. It's a large cap offshore service vessels. These are the vessels that bring the men and equipment out to the rigs. It's severely depressed industry, and you will see the recovery. They support all this offshore drilling. Is the company depressed right now? Yes, but if you look at some of the factors in the industry, every 3 years, these 3 to 5 years, these boats or all ships have to go through a recertification program that costs millions of dollars. So if you have something that's been sitting on a dry dock or sitting up on the land on dock on some of these boats for 3 to 5 years in the weather, does it make sense? It may not be worth to spend $3 million to put it in a dry dock and try to, recertify it so you can put it back offshore. So its supply is shrinking again. This is the overall theme we're seeing right in all these discussions we're having. Demand is either increasing or at least not going down, but supply is definitely going down. And you don't need a massive pickup in demand if supply in these various industries we're talking about for sectors is declining. And that's what we're seeing. That's the same thing we're seeing. But again, it's a patience issue. People, can look at previous cycles where it is an indefinite recovery, but the stock prices don't reflect that. And so it's another opportunity to get in still in the first inning, if you will.
Certainly the onshore in the U.S. has just had capital thrown at it, and that is still washing out and has yet to fully take its effect. Bad capital, misinvestment, and that is still coming off. And then offshore, John, like you mentioned, I think it goes back to BP Macondo. That accident in the Gulf has been why we are still here, where there's been a tremendous opportunity presented, and that now is starting to pick up yet again. And I think there's some interesting situations there that you can take advantage of, and appreciate you sharing some of the names. Can you speak just a little bit more? You touched on it. Can you go into the oil and gas rate of depletion versus new discovery reserves for oil and gas?
Yeah, that's another topic that I've been talking about a lot lately that I think people gloss over. They think, well, the marginal barrel is what determines the price. It's the same thing in the shipping industry with shipping. But to your point, because of the lack of investment, these are depleting, these are extractive industries. So that means that you're taking these reserves out of the ground, whether a mine or out of an oil well. They just don't go forever at 100 barrels a day forever. I mean, they have depletion. And if you look at the overall oil industry, currently the demand for oil is around 100 to 101 million barrels a day. That's a lot of oil. That's 3 billion barrels a month. That's 36 billion barrels a year of oil production or demand. And that is growing, just going back to what we talked about before, because of the emerging and frontier markets. You can throw this in a spreadsheet. You can go look at the oil consumption S-curve of a country like South Korea or countries in Western Europe as they developed at certain GDP levels. Goring and Rosenzweig has excellent information on this. If people go to their website, they write about this. And you can see, like we talked about, Indonesia, China, India, plug it in, just use South Korea's annual per capita rate of oil consumption and plug the thing. You're getting up to 120 and 130 million barrels of oil demand. If you get to South Korea type levels, you get to Western Europe type levels, you start getting into even higher demand levels. And if you want to use the U.S., which isn't probably appropriate because we have a car culture here that a lot of people don't have. But suffice to say, I mean, you have this constant demand. Even during the 2008 financial crisis, I mean, you had a small decline in demand, and then it rebounded the next year and has grown at 1 and 1.5% a year. So that's 1 million to 1.5 million barrels a year of new demand. Plus, if you want to look at the overall depletion of the industry, depending on who you want to talk to, Rystad, Exxon, you're anywhere from 4 to 6% a year. So you are depleting the overall 100 million barrels a year of production 4 to 6%. So that's anywhere from 4 to 6 million barrels of new oil that needs to be found and brought online every year just to account for depletion. So now you add the growth in demand with depletion, and you are looking at replacing anywhere from 5 to 7 million barrels of oil production every single year. And that requires hundreds of billions of dollars of investment, consistent investment over time. Again, you can't just dial up India and have a couple guys go on a heater and create a new oil field for you and overnight on a computer. It takes a lot of time and effort and money, and it just hasn't happened. So I think I saw a stat recently over the last several years, we've only replaced 1 barrel for every 6 barrels that we have been using. So you can look at any chart. I have these in my weekly discussions on YouTube and in my newsletter. I mean, the underinvestment is tremendous, and we are really going to be having in the next couple of years, we're going to have a tremendous response in the oil price because the demand, it's inelastic demand. Once somebody in India or China buys a car, they don't park it in the garage and just let it sit there. People use these vehicles. So it's just a math problem. You can, create a spreadsheet and just, figure out where you want to go, and then look at all the comments that are being made by the oil companies, or even what's going on in the with Saudi Aramco or some of these other people. The investments just aren't happening. So I think that at some point, if you don't make the necessary investments in an extractive industry, you're going to have a supply crunch. And again, it's a cyclical industry. You have to catch the cycles at the right time, and you can make tremendous amounts of money. So depletion is something that people don't even talk about. And I'm not like peak oil in this thing. I think if the price gets high enough, they'll go out and find every marginal barrel that they can, but the response takes time. So you could have a 2 or 3 or 4 year environment. We all recall, when oil prices, I remember in 2008, when oil was $140 a barrel, even Nancy Pelosi was saying that she was open to considering opening up drilling offshore California, because the response, people are paying $6 or $7 a gallon for gasoline. Everybody's going to get on the bandwagon. So now again, if you're of the persuasion, there are people out there, I talk to them, that think oil is going away, that we've reached peak demand. That seems to be the current fashion in a lot of the discussions. I don't believe that based on what I read in my travels. People in Uzbekistan or Malaysia or in Indonesia, they can't afford a $65,000 or $70,000 Tesla. That's just not going to happen. They buy small cars, Hyundais and Toyotas, and use them. So I just don't see there's going to be an energy transition at some point. You can't have unlimited growth on a finite planet. When and where that happens, I don't know, but I certainly see at least one more very large oil price response based on the demand and supply scenarios that we've just talked about.
Well, that's good stuff, and you're absolutely right. It's amazing how price can change the opinion of folks who are on the other side. And I think offshore is going to be a significant contributor to going forward on this. I think offshore is really the place that really makes the most sense. And as you said, as the price keeps going up, at some point, all of that marginal crappy projects will start to come on and contribute to the next cycle. Well, let's move over briefly to precious and base metals, John. What's your view on this market, and how are you participating in this sector?
So I think that we're in the beginning stages of another run in precious metals. I think the bull market, we've had probably, almost a decade now of prices going nowhere, but I think that, we've reemerged from that. And I think that, from a perspective of gold, I guess I'm old school. I'm 52, but I've done a lot of study on monetary theory and what's happened with monetary systems throughout the history. And I'm not a doomsday gold bug type person. I'm not a James Dines type person, but I do take a pragmatic look at things. And I remember I've shown this video and I've shown other people. Ray Dalio was giving a talk at the Council of Foreign Relations, and he was talking about currencies, and he was talking about gold specifically. And he said that in his own personal portfolio, he looks at gold as a currency. He looks at it as insurance against central bank and government malfeasance, which is endemic around the history of the world. It goes without saying. People that deny this are living in some alter reality. And he was laughed at. People at the Council of Foreign Relations laughed at the CEO of Bridgewater, one of the largest money managers in the entire world, because he said he advocated for at least a 10%. And he said, if you don't have some allocation to gold, you don't understand history and economics. And I think that sums it up. That's something that I use. You really don't. I mean, it's insidious what has happened. We talk about wealth inequality. We talk about all these things are becoming mainstream, and all this shiny object of socialism and things that are being taught to people that as a solution, and no one looks at what the Federal Reserve has done to the middle class in this country. Over time, you should have a slight deflation or disinflation environment, and a working man's wages should become more valuable over time and not be dissipated through constant monetary malfeasance by the central bank. And that's what's happened. And that's why you have a large part. It's not all of the reason why we have wealth inequality, but it's a large reason why we have wealth inequality. I mean, obviously, we're savvy enough, and a lot of the listeners here, that we participated. I mean, my standard of living continues to go up every year because I am able to participate in these markets, or I'm on the right side of whatever, in renewable energy. But, if you're working in a factory job up in Michigan and you're not as educated or understand these things, you might get a 3 or 4% wage increase over the, portion of your contract, 3-year contract with UAW and GM, but you're actually losing purchasing power. And people don't understand it. It's the frog being boiled. You don't just throw a frog into a boiling pot of water. You put him into a pot with cold water and slowly turn it up. And he never understands that he's being cooked alive. So I think that, most people really don't understand these things. They're not taught, obviously. I don't remember being taught any of this in high school or any of my college classes. It was all Keynesian economics and a bunch of BS that doesn't really apply. I mean, I don't even teach people how to even run a checkbook. So, I mean, I think that from that perspective, to get back on track on the gold, I think we're in a new bull market. Why? There's a tremendous amount of money printing going on around the world by all kinds of governments. There's a tremendous amount of debt out there, and that debt can't be serviced. There's a lot of malinvestment, and that's why we're seeing zero interest rates all over the world. I mean, for heaven's sakes, I think I saw last time I heard or read 13, 14, 15 trillion dollars in negative yielding government bonds around the world. This is not normal. And I remember, I was just talking to my father about this. I remember back in the early 80s when interest rates were 15, 16% on T-bills, and my father taking my grandparents down to the Federal Reserve Bank in Minneapolis. They withdrew all their money from the local banks. They were getting 3% in their passbook savings, and went down and bought T-bills at 15%. You can't even put money, if you're a retiree or a saver, where are you going to go? These central banks have turned everybody into a speculator. You have to reach for return. That's why you see all this malinvestment. The pension funds are in the same. That's why they finance the shale boom, because the bonds were 7 or 8%. So insurance companies, I mean, I wouldn't want to be running a pension fund or an insurance company trying to match my actuarial tables with 0% interest rates or 1%, 2% T-bond yields. It just doesn't work. So I think from an individual perspective, if you look at all this, it just can't end well. And now you have a lot of new up-and-coming politicians talking about modern monetary theory. It's just money printing wrapped with a PhD veneer of left-wing politics. That's my view, at least. Doesn't work. It's been tried before. So I think people need to have an allocation to gold and precious metals in hand, if you will. And then if people want to speculate in gold mining companies, now you're back to, the same discussion we had about, junior investing, resource markets, like with uranium. You really got to do due diligence. Now, I will say, if I take a breath, come up for air here, I would take a look, something that piqued my interest, if you're just an average investor that wants exposure, without getting into the junior world. That's another, highway robbery potential deal there. But Frank Holmes over at US Global Investors came out with a new ETF. It's called GOAU. and people can go look at that, but it has a big emphasis on royalty and streaming companies. Now you're talking about your Franco-Nevadas, Cisco, Wheaton Precious Metals, and historically these companies don't have the same risk as gold mining companies. They've been able to have high returns, a return on investment, even in stagnant gold markets, and you won't get the same juice or run if we have a precious metals bull market like I think we will. But you can participate, and you will have a high concentration in a lot of the royalty and streaming companies. And that is not a market-based ETF. That is they have a methodology around profitability and return on investment that they use to choose which companies are in the ETF. So a lot of your GDX and GDXJ, I would stay away from that kind of stuff. It's market-based, market cap-based. But if I wanted to dip my toe in there and have some exposure to precious metal companies, and I was just a general investor, I would take a look at that product. It has a low expense ratio, and I kind of like what they're doing. And it has outperformed in its short history the GDX and the GDXJ. So, and I think if you just want to be an individual stock investor, take a look at some of these royalty companies. I like, obviously there's large caps like Franco-Nevada, but a Sandstorm Gold has set themselves up for the next 3 to 5 years with some of the royalties they have coming online and streaming. And then there's this junior I'll mention that I'm pretty high on. It's kind of overpriced right now, but the management team is outstanding, and I think they're really setting themselves up, and that's Metalla Royalty. It's in Vancouver. I think it's the only company on the Vancouver exchange that pays a dividend. So it's a smaller royalty company, and they're rolling up a lot of silver royalties, but that's a junior I would take a look at if somebody was interested. But you start getting into the gold mining sector, that's has a historic, same thing, it's tiered. You got your producers, developers, project developers, stuff like that. But I think if I was going to participate, and I think gold's going to make new all-time highs in the next several years. That goes without a doubt, just because of there's not going to be any alternative except for to create more currency units. And I think that's going to, and I think we are, we're moving away from globalization back to nationalism. That's going to increase costs, inflation. I think there's an inflation bias coming back. I remember seeing The Economist magazine several months ago had a tipped over dinosaur that was deflating like a bouncy castle. It said, inflation is dead. Well, that's the magazine cover contrarian indicator right there. It was the same thing in oil in 1997 when oil was $10 a barrel and said oil was dead. So these guys always get it wrong at the inflection points. I think the gold price is obviously moving higher in step fashion, but I think we see all-time highs in the next several years.
Yeah, and this is good thoughts and good views, John. I appreciate you sharing that information. And certainly I can't stress enough the use of actual physical precious metals, not paper, none of that crap. The actual physical precious metals, whether it's partially stored and partially in your possession, whatever, take your pick. But certainly the physical exposure is really key at this point, and gold should make up a large portion of that physical metals portfolio. And certainly on the royalty side, I just have to add, and it's no secret, but certainly Sandstorm Gold is fantastic, and a company called Maverix Metals, which is in that twilight zone of not quite to a Sandstorm size and not a very, very small company. And it's just in that growth area that has a fantastic situation that's occurring there. So certainly take a look at those and the ones that you mentioned as well. Now, can you speak to, is there a gold producing company you like? Is there one or two that you want to mention to the audience on that side? And then also, can I get your view on copper?
Well, I have some smaller companies I'm looking at. They're in my newsletter. I don't really want to get into the junior ones because the write-up on them is you really have to understand what's going on. But I'm mostly in the royalty companies that I mentioned, and I'm a big holder of Sandstorm. I do have shares of GoAU. I have two juniors in the portfolio, but I really don't want to get into talking to them. And I really haven't done a lot of I've been burned so many times on these gold companies that I'm really hesitant to talk about them outside the royalty space. But I will talk about one company. I am a very big bull, switching to base metals, specifically copper. I'm I'm a big fan of Robert Friedland, the guy that developed the Oyu Tolgoi mine he found it, his Ivanhoe Metals found it. And what he talked about at a recent conference about the copper price. Copper's in the same boat as everything else, irrespective of what happens with EVs and renewable energy demand. Copper, we're finding less copper, lower head grades, harder to find. Incentive price is a lot higher to develop new mines, and we have copper demand that's growing at 3% a year. And we kind of know where all the big copper resources are, so I'm not sure where they're going to find all this new copper that they need. We are looking at deficit of this year. I think it was around, last time I looked, 350,000 tons, and this just gets worse as we go forward, especially if electric vehicles and some of this renewable stuff keeps going at its current pace. But it's the same thing. You have, when you're talking about mining, you have a lot of risk. There's a lot of juniors out there. It's the same thing. It's tiered again. But I found one company that I like, and I will mention it. It's in Chile, and it's been around for a while. But I think recent news. I owned them several years ago, and then they weren't doing so well. And then they've made some recent news that I think I like what's happening there, and it kind of will tail into the rising copper price I'm thinking about. This Marigo Resources. They just process the tails from Codelco's operations. Basically, you have a big water cannon. They blast the tailings. They go into a sluice. They go down to the plant, and they pull the additional remaining copper, molybdenum, out of the tailing stream. They also have another tailing stream coming from a current mine that Codelco has, which is the National Copper Company of Chile. And these are long-term projects. I mean, you have decades of production here going on. So what's interesting and why I'm excited about the company currently is because they did a big expansion to expand their production. They just basically commissioned that plant, brought it online. It's almost doubled the production. So the current copper prices, they actually lowered their cash costs and all-in costs. It's going to take a couple quarters to get it lined out. Any kind of new process you bring on takes a couple quarters to line things out. So I think they're not making a ton of money right now. They are cash flow positive, I believe. And I think, though, where I think copper's going well over $4, $5 a pound in the next several years, or as Robert Friedland says, he thinks it's going high enough where you're going to need a telescope to see the price. But I think a company like that, you don't have a lot of mining risk. You basically are processing. You kind of know what you're dealing with there. So I think somebody wants some copper exposure. That would be an interesting thing to look at. Things like that. I'm always looking to hedge my risk with these companies because mining is really a crappy business. It really stinks. It's hard to do. It's capital intensive. A lot of things go wrong. Like I said before, everybody's in there trying to wreck the project some way or another, whether it's outside sources, even guys in your company that don't know what they're doing. Anything can happen. So, if you catch the bull market, that's fine, but I'm looking always to try to hedge my risk or find something like that where your risk is a little bit lower. That's why I like royalty companies. And in that space, if people want to take a look at it, I've owned this company for a long time, Altius Minerals in Canada. Outstanding management, knows how to play cyclicality. I mean, they were amazing during the last down cycle. They held back, they had their cash, they held, and then they bought a bunch of copper and other royalties, and now they're enjoying increasing cash flow and same type of situation, the upswing. So cash flows are up, buying back stock. It's not going to be a 10-bagger, but it's something that, if nothing else, people should read their presentations because they just explain the cyclicality of these resource markets and how to properly take advantage of them. But Marigo I like for copper. I have to say I like the this is going to be a little bit too much for some people, but I still have a fascination and belief in Mongolia's future. It's kind of lined things out there. Just in general, that country, I would stay away from Turquoise Hills right now because I think that Rio Tinto and them are having some issues with the block and cave that they got going on there. But Rio Tinto does know how to mine, and I suppose that they will eventually figure it out, but that could be a speculation. people should keep an eye on Turquoise Hill, because if they do get the underground situation straightened out and the Mongolian government doesn't go schizophrenic again, they could have a tremendous run also. So other base metals, nickel, big fan of nickel. I think it's undersupplied again. The Indonesian government, people know what has happened there, where they have banned exports. That was supposed to happen in a couple of years. They brought it forward. That's influenced the nickel price. Just real quickly, if you want a twofer on nickel and gold, I like Independence Group in Australia. Outstanding management team, very highly profitable nickel mine. Plus they have a gold mine that's producing about, I think, 150,000 ounces a year. I think their partner is Ashanti, Anglo Gold, and that's a very high profitable mine too. And you know, a lot of people, especially in North America and Canada or U.S. and Canada, they don't really look at a lot of the Australian companies, and I think there's a lot of potential there. But I do like them, because I think the same thing that applies to copper is going to happen in nickel.
Lots of good information, John, and certainly I agree with you. The Australian component for us in North America is probably lacking for a lot of investors. I certainly see that happen quite a bit, and it looks like you're seeing the same thing. And Amerigo Resources, certainly, you know, we spoke to Ross Beatty a couple of weeks ago, or whatever it was, a month ago, and he continues to hold that company. They have a unique situation. You know, they're not, they don't have all the risk of a general operating company, so to speak. They're kind of have a nice little unique niche market there. And of course, we had that stock for a couple of years and did really well with it. We haven't got back into it, but we've done really well with that stock in the past. It's on the watch list yet again. And of course, Ivanhoe Mines over with Robert Friedland seems to really just keep moving along in light of all the negativity regarding the DRC and South Africa. Somehow he's able to keep the wheels greased and keep things moving over there with Ivanhoe Mines. On the copper side, in addition to Amerigo, as you probably know, we do have a highly favorable opinion of Taseko Mines with what they're doing with a new project coming on in Arizona and their existing operations. I think that they have a really good, unique situation that's starting to come out more, and some very interesting opportunities out there. And of course, folks know that in our portfolio, as far as some good gold companies out there, obviously your senior producers there's a couple good ones there, and in the mid-tier sector, I think that there's quite a few good ones as well. Certainly Equinox Gold is there now with their production and growing significantly. A company called Lee Gold Mining, which not a lot of people pay attention to, also has a fantastic growth profile and existing production. So these guys are looking quite good. And of course, Clive Johnson over at B2 Gold, fantastic operation, and seems like Clive can go just about anywhere in the world and get stuff done, and has very little troubles on the government and social side, which is also a good thing. Let's wrap up here, John. Can you highlight for us the various services and features that you provide at Actionable Intelligence Alert, and how can the audience sign up?
Yeah, I mean, like you mentioned earlier, I do a lot of research. I should say it's just myself, but I do have a lot of contacts, met a lot of people. So I kind of follow Munger. I keep going back to Charlie Munger. It's like, you know, I try to find the best minds out there with the best ideas, plus my own ideas, obviously. But that's a good way to do things, because, you know, you can't invent everything yourself or come up with every idea. No one's that smart. So I have a lot of contacts, and I think that's what we try to do. We try to identify, like we've talked about here, especially highly cyclical, undervalued markets that have high potential for an asymmetric payoff, and then try to find a vehicle, whether it's a stock or whatever, to take advantage of that. So that's what we do there. We have a portfolio that comes out monthly. A newsletter comes out monthly. You can just go to the website that you mentioned earlier, actionableintelligencealert.com, and there's a subscribe button there. If you also go there and sign up, there'll be a pop-up. If you give your email address, you'll get on our mailing list. We put out a lot of free content and weekly email talking about these exact same things that we've talked about during this interview, more in a general sense, and that kind of gives you a good, you know, you can assess my thinking if it's correct or if it aligns with your particular views also, or piques your interest. And then but we also have the YouTube channel that's been taken off, and we do a weekly video market wrap, if you will. We talk about these same issues, have a lot of interaction there in the comment section with a lot of smart guys, answer questions, whatever. talk about these particular and do a lot of updates, because most people can't follow this stuff as tightly as we do. And so I try to update folks on what's going on, or if things are, how things are progressing in these various recoveries in these industries. So they could get me there, or on Twitter. I really encourage people to get on Twitter. I mean, it's not really like Facebook or any of these goofy things with cat videos. There's a lot of good FinTwit and Uranium Twit guys out there. And if you start following myself, you'll start being exposed to like Marcelo or Mike Alkin and all these guys that are out there. And a lot of guys that only have maybe 1,000 or 2,000 followers. There's a guy up in Canada who's been doing yeoman's work on Canadian Energy. He's the last fund up there, a guy like Eric Nuttall. I mean, you will start, you can just be a lurker. You can say, wow, that's interesting, or I didn't know that, or people put links to different research that you wouldn't normally have access to. So those three avenues, the website, the YouTube channel, and on Twitter, I think are the best ways to get a hold of us or follow us.
Excellent. Well, John, it was really good to chat, and really appreciate you coming on the show, and look forward to having you back again soon.
All right, Andrew, I really appreciate it. And like I said before, I really like your work, what you guys do, and was really excited about having this interview. So I appreciate it. Thank you.